This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Well, it's all right. Everything will work out fine. Well, it's all right.
All right, so, I love this song. It's all right. Like, I feel like...
Traveling Wilburys?
Yes.
Yeah, Traveling Wilburys.
Well done, well done.
Well, I was a big Roy Orbison fan when I was little.
Okay.
You know, when you're a kid, you could become obsessed with a certain artist. Like my son, who's going to be 5 soon, he likes David Byrne. Just like every time we get in the car, he wants to listen to David Byrne.
But is it because you guys play it?
It's because we played, the concert that he did a few years ago, and it's like that's his reference point for music at this point. So it's like, okay, so that was me and Roy Orbison.
I will say...
So I like the Traveling.
I totally get it. My daughter grew up on the Concert for George because that's what my husband and I were so into. So it was all about, unfortunately, the passing of George Harrison. But Eric Clapton put together this incredible concert of all his music and the musicians who were part of it. And so, there was no Barney. There was none of that in our house.
Hey,
and we would play it, and she would bop around to it. So it was like kind of great because we loved it, and it was a really big concert and lots of music. So.
And you get spared from the traditional kids' fare, which leaves a little to be desired. Anyway, we'll play some Traveling Wilburys at home later tonight.
All you new parents, just a little advice: just play that, and you'll be very, very happy.
I want to take a look at the markets, Carol, because
sure.
the Nasdaq, as you mentioned, is down over 2%. We're seeing shares of the major indices at their lowest levels of the day. The S&P 500 down more than 0.9% right now. The Dow down more than 0.2%.
I guess what I would say, and it was interesting. I actually finally made it back after traveling in COVID last week and joining Katie and Manus Cranny on the surveillance team in the morning. And we talked to a lot of different market guests. And I feel like in terms of a theme as we were getting ready for 2024 is that there was a bit of a dialing back in terms of the thoughts about how aggressive the U.S. Central Bank, the Federal Reserve, would be. Markets have been pricing in about 150 basis points of cuts this year. And there was a dialing back in terms of that as we try to keep kind of still a close watch to make sure inflation doesn't rear its ugly head again.
So this is a question that I have for our markets guests a little later in the program, but is this a macro story or is it a collection of micro stories?
What do you mean?
Is the decline that we're seeing today a result of, the stocks being down as a result of ASML Holdings canceling shipments of some of its machine? Or is it because Apple's down the most since August and at its lowest level since a couple months ago? And all of this is just putting pressure on the indices. Tesla missing on deliveries, Rivian taking a hit. It's like a lot of micro company specific stories today rather than any macro themes or economic news that we're getting.
We did hear a lot of guests saying it's going to, you got to look for specific fundamental stories and look for stocks that are undervalued versus some of those who really had a big run up in 2023. All right. So, folks, it is a new year and we've got a bunch of economic data points coming this week, a lot of it on the labor market, culminating in the monthly jobs report come Friday. We also get FOMC minutes from the last meeting of 2023. As you know, we have constantly, Tim, couched everything in the past 4 years against the global pandemic.
The big question, of course, is, what do we see moving forward? Well, according to Bloomberg opinion columnist Allison Schrager, this year we can probably put the pandemic dividend to rest. With more on her column, let's bring in Allison Schrager. She's Bloomberg opinion columnist and senior fellow at the Manhattan Institute. Allison, good to have you with us this afternoon. So what exactly has been the pandemic dividend? Carol and I were talking about it earlier.
We were.
I can't believe it's been almost 4 years since the start of the pandemic.
Crazy.
And what's the impact that the pandemic dividend has had?
Well, it's hard to say a dividend although I call it that, just because it's been such an economy that effectively gave us a free lunch when it came to monetary policy. There's a reason why every economist thought there'd be a recession to bring down inflation, because it's always been true in the past. There are certain things about the pandemic that made the economy kind of a little unusual this time, that meant that we pretty much could have what seems like a soft landing so far. Effectively, you had a very tight labor market, and you had households with a sort of very good, healthy balance sheet, which if you compare that to 2008 was really different. So you had more trade-offs. So effectively, you could raise rates. You also had people less sensitive to rates, largely because of the mortgage market. And you could just effectively have what seemed like costless monetary policy, but it seems that there's a lot of reasons to think this wouldn't be the case going forward.
So in terms of household spending, Allison, I don't need to tell you, right? It's so important in terms of consumer spending to the U.S. economy specifically. Household spending, are they, I mean, at this point, we keep talking about, credit card debt, the buy now, pay later programs. We've seen an increase in an uptick on that. Is it going to be tough for consumers to continue spending after getting really some nice juice, if you will, through the pandemic, courtesy of the government?
Well, I think what we're seeing, if we look at the data very carefully, is a tale of two economies. So the bottom 50% had some savings left over from the pandemic, but those are largely gone, and that might be why we're starting to see delinquencies up for credit cards. But for the top 50%, they still have a lot of cash, and housing prices are still largely higher, and you have a lot of people locked into cheap housing costs. So it's sort of the have and the have-not. Some people are walking away richer, and some people finally have caught up with them. And we're seeing saving rates fall, and we're seeing much thinner balance sheets for the bottom 50%.
What about when it comes to the labor market? We keep hearing about this incredibly strong labor market. Month after month, we're seeing hundreds of thousands of jobs added to the payrolls. We're not hearing it from companies the same way when it comes to the fight for talent. But how are you reading into labor numbers?
Well, I mean, if you look at vacancies, they still look way up, which suggests still a labor market. And anecdotally, I keep hearing employers saying they can't find talent. But a study came out from the Minneapolis Central Bank that found that how we're measuring vacancies might be wrong. And they have an adjusted measure that accounts for new technology and how people search for jobs. And they found that actually vacancies are pretty much where they were pre-pandemic. So, a healthy labor market, but not the tons of, say, slack in it that we had like maybe a year ago.
Allison, that 2% mark that the Fed has promised, reading a bunch of stories last week, I think by one metric we've already gotten there, but there's still that concern in talking to a lot of market guests that we could see another uptick potentially. So how will the Fed's pursuit of making sure no more inflation can come back and rear its ugly head is going to potentially put a soft landing at risk?
Yeah, well, I think the way I'm thinking of it is there's a lot less room for error, as opposed to you had a lot of room for error before. And I think the way I think about it is we have no idea what's going to happen. One thing's for sure, shocks are going to happen we can't anticipate. And the economy is just all around less resilient. So if there is an oil price shock, I said expectations appear to be anchored, but there's some signs that they're not so well anchored anymore. So if we do see this uptick in inflation, it could really take hold. Do you think pre-pandemic people had no concept of inflation? People our age really didn't have much memory of it. But now people sort of expect it. So if there is a shock that increases inflation in any way, then we could see expectations become destabilized, and then the Fed will be in a much more of a bind.
I went to buy a Christmas tree. It was off the chart.
Where did you buy it?
Locally,
How
up
much
the
was
street.
it?
I'm not even going
to. I'll tell you how much I paid for our Christmas tree.
Hundreds of dollars.
Hundreds? Wow. I paid $80.
I'm just going to tell you.
I think it was actually $74 plus tax.
It was crazy. It was crazy. And we were kind of,
I'm just going to throw out some advice for next year.
Yeah,
Apparently, you have to go to the big box stores, which is what we did.
I remember someone, I think.
It was like half the price of just going up the street.
Like Home Depot, even a Whole Foods.
Yeah.
Like they do trees, I think, like right away, and it's less expensive.
Yeah, but I threw out my back pulling it off the car. So
so your doctor bills.
So that's the payment that I get. Okay, I want to get back to Allison. First of all, Allison, thank you for saying that we have no idea what's actually going to happen. That's a refreshing thing to hear at the beginning of the year when everyone is out predicting everything. You mentioned a potential oil price shock. What else is on your radar that we should be watching here?
Well, as I said, I'm also looking for sort of surprises and things to happen to the labor market. I think that's the big concern because that's, ultimately I think if people experience sort of job insecurity, then that will make spending completely collapse. And that's largely been holding up the economy, is a feeling of this resilience. So I think anything could happen to the labor market. Certainly the geopolitical situation can mean all sorts of sort of surprising things. So, those are the two things I'm really looking at. Because oil prices tend to, anyway, they're not really in core inflation that the Fed looks at. They do really sort of shape perceptions and, honestly, the bottom line for most households.
Yeah, they only mean something if you fill up the tank, which I do regularly.
Just a reminder for our friends in California. Well, they don't need to be reminded. Our friends outside of California, how expensive gas is there.
Right.
Routinely $5 a gallon.
In California?
And driving back from the airport here the other night, it was, under $3 a gallon. Just a reminder how much more expensive it is in California.
It's a really big difference.
Yeah.
All right, Allison Schrager, as we said, Bloomberg opinion columnist, senior fellow at the Manhattan Institute. Check her out on the Bloomberg terminal at Bloomberg.com.
Hundreds of dollars for a tree?
It was delivered.
But
still, even that was just a piece.
So it's the delivery person's back that has been thrown out as a result of the tree.
And it got kind of lost in the shuffle. My daughter was trying to do us a favor.
Is it still up? Is the tree still up?
I'm keeping it through Easter. This is Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Hey, listen, I don't know if you guys have noticed, more challenges, it seems, for Rivian Automotive. Shares are tanking. They're down about 10% today, so near their lows of the session after missing expectations for quarterly electric vehicle deliveries. And then, Tim, you've got something being made official. Tesla no longer the global top seller of EVs. And that stock, it's been bouncing around today, right now down about 0.7%.
Yeah, China's BYD delivered more, becoming the new number one in EVs, driven mainly by its much broader lineup of cheaper models in China. We got a lot to talk about for Bloomberg Plugged In. It's our weekly look at the world of EVs. With us is Ed Ludlow, the co-host of Bloomberg Technology. He's in our San Francisco bureau. Ed, I want to start with Tesla versus BYD because most people listening right now, even if they've heard of BYD, the Warren Buffett-backed Tesla competitor, EV maker in China, they've never even seen one of these cars driving around. What does BYD's lineup look like?
Well, that is the story, that the concentration of what they do is in mainland China, serving a domestic market where they make lots of different EV models. But the principal difference between BYD and Tesla is that it's at a lower price point. And one thing that BYD does that's very different from Tesla is that alongside battery electric cars, full plug-in battery electric, they also do plug-in hybrids, where they sell many of them as well. So you're quite right to point out that in the fourth quarter, the final 3 months of 2023, BYD sold 526,409 fully battery electric cars, most of them in China, whereas Tesla handed over 484,507 globally. But if you aggregate it over the course of the year, BYD is only bigger than Tesla on an annual basis in 2023, if you include plug-in hybrids. But Tesla still sold more battery electric overall that year.
But is the trend clear?
Oh, the trend is clear, and so we knew that this was going to happen going into these fourth quarter deliveries. The question more on Tesla's side is, where are they still growing geographically? And I had Dan Levy of Barclays on the show earlier today saying that, it's possible you can have Tesla continuing to grow in China because it doesn't make the lower end EV. It's used price cuts as a lever, particularly in China, but it's still seen as more of a premium product there than BYD. Then the next question is, what about those early adopters? If you're an early adopter and you were like the first to get into an EV and you've been and gone, what's left over on the demand side?
I do wonder, what about China? Do they love having Tesla there? Not only, making vehicles, it's a higher end product. Give us some backdrop and some history there. Yeah.
It's fair to say that Tesla and indeed Elon Musk directly has kind of had a up and down relationship with China. The Chinese government was incredibly supportive for the construction in the first place of the Shanghai plant. 50% of all of Tesla's vehicles globally are built in China, in Shanghai. So it's clearly an engine room for their production base. And they were very helpful in financing, things like that. There have been some clashes over data, the ownership of Tesla vehicles by government officials, for example. But on the whole, it's clearly an important relationship between the two. The big difference between what's happening in China and what's happening here in North America is there are just many, many different EV makers. There are so many more models out there that you can buy. And as you pointed out at the top of the segment, many of them the average American would never even have heard of, the brand nor the model. And so it's a more fiercely competitive market with many more players.
Does it tell us anything about how an EV market could unfold here in the US? Or are the big three just too entrenched in American society?
Tim, I think I heard you praising your last guest for saying that we don't know what's going to happen in 2024, and that's refreshing. And I think that is the answer for the EV market. There is certainly now a big question mark over demand. You know, in the past, Tesla, as an example, has leaned on the idea that its production was greater than its deliveries because there's always a mad scramble at the end of the quarter where vehicles get caught in transit. But there, you know, if you move past that, and it's relevant with Rivian as well, you do come to the point where you ask, is the demand really there? That will be the question for 2024. And in this market, in particular, North America, you will have seen the news over the holidays about the federal tax credit. The number of EV models in this country that are eligible has basically halved from 24 to just 13. And those rules are now determined by basically, if you want to buy an EV and you want it to be eligible for the full $7,500 federal tax credit, which is a big incentive, right, to buy something if $7,500 off, it depends on the exposure that its components have to Chinese ownership. In other words, if your battery has a component that has ownership by a Chinese company greater than 25%, it won't be eligible for that tax credit. And incentives are really key in this market still.
You know, I do wonder too, Ed, when we talk about the EV space, you know, Tesla certainly had the first mover advantage. We talked about that, I feel like, you know, for some time here, how that really helped Elon Musk and Tesla specifically. But as more and more companies, higher end, lower end, you know, come into the EV market, you know, does it make it more complicated for Tesla, or is it just a case if it's going to be a market with, you know, like the auto market today, a lot of different players?
Yeah, I mean, the concern that a lot of analysts have about Tesla is that it doesn't have a very refreshed lineup. Mm-hmm. You know, we talk about the Cybertruck being the kind of big story at the end of 2023, but most analysts see that being a pretty low volume product. If you are kind of a sci-fi fan and you're an adventurer and you like being a bit different, you might buy the Cybertruck. So that's the risk. There is an advantage, and many maintain that being the market incumbent, particularly in North America, is Tesla's strong point. But there is also brand loyalty in this country. I think I've brought this up on this segment so many times, but if your father drove an F-150 and your grandfather drove an F-150 and somebody offers you an electric F-150, there's a good chance you'll buy it. And so that's the concern for analysts. They want to see Tesla bring in different types of models to keep the lineup fresh, to attract new buyers, or bring in models that more closely match the type of car that a gas engine car owner already drives.
Well, and Elon is said to be, right, doing a revamp of its Model Y from its China plant. So maybe
yes,
he is listening to what the public is saying.
Yeah, and they did that with the Model 3 too, but what was so interesting is they did it in Asia or China first, then Europe, and we're waiting for those things to materialize in North America. Conversely, you know, the Cybertruck is in North America only right now in really low volume. So they have different strategies depending on that product type.
Hey, just want to get your thoughts on Rivian, Ed. Shares down now by about 10.7%, falling the most in almost 3 months. The company reported quarterly deliveries that missed expectations. Why is the stock taking such a hit with this kind of, you know, slight miss?
Yeah, it depends how much you believe the delivery story that Rivian tried to paint on the last earnings call. Rivian makes two consumer EVs, a pickup truck and an SUV, and it makes a commercial van for Amazon. And what they guided us going into this quarter was that the holidays are the biggest time of year for Amazon. They're not going to take delivery of brand new vans while they're trying to maximize those already on the road. It's just logistically too hard. So they said there would be a discrepancy between production and delivery, where delivery was lower because Amazon would opt not to take delivery of those bug-eyed delivery vans. But the CEO, RJ Scaringe, has told me over a number of years now, the van is only 20% of production. So you do the math and say, okay, well, you warned us this would happen. You're going to deliver fewer electric vans, but the vans are only 20% of your production. So why is overall production so much higher than delivery? And what does that tell us about the demand for your consumer vehicles? And there seems to be a lot of concern that that's not adding up somewhere in the market's mind.
All right, we're going to leave it on that note. As Tim mentioned, Rivian shares down about 10% in today's session. Company reports February 21st, so mark your calendars in terms of an update. Ed Ludlow, so appreciate it, co-host of Bloomberg Technology in our San Francisco bureau.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, everybody. Apple slumping the most since September. Shares down 3.6%. You heard Charlie just talking about it after Barclays cutting their ratings and price target on the stock. Analysts, they are bearish over an expectation of soft demand for the latest iPhone and a lack of new features in the next iteration of the iPhone, arguing that it's just not going to prompt customers to go out and upgrade. I don't know. I need a new phone. I need a new watch. There's a lot of Apple that I have to be buying.
You definitely need a new watch. You have like the first
it's an
version of the Apple Watch.
Antiques Roadshow is calling.
Which phone do you have?
12?
Okay, yeah, you should probably get a new phone.
Well, Dan Ives has the opposite take. He is not a bear. Just a couple of weeks ago, coming out with a note that argued that Apple is going to be the first $4 trillion market cap company, and that will happen by the end of this year.
It's $2.8 trillion right now.
Yep, so a little ways to go. He's got an outperform and a $250 a share 12-month price target on Apple. Dan, by the way, Managing Director, Senior Equity Research Analyst at Wedbush Securities. He's joining us from New York City on the phone. Hey, Dan, so good to have you here. My new year already feels better. What do you make of this call at Barclays? I'm going to assume if you were in a debate, you'd be like, nope, you got it wrong.
I mean, it's like Groundhog Day, the movie. Look, we've seen this before, right? I mean, every year, the fire in a crowded theater, first few days of the year scares everyone. The reality is, I mean, as someone that spends so much time in Asia, this iPhone 15 upgrade cycle has actually been strong. I mean, China has come through, I think, actually much better than feared. It's about the install base that many just continue to underestimate. You're talking about the best install base in the world, services, double-digit growth. I think a year from now, this is going to be a $4 trillion market cap.
What do you make of the channel check weakness that Barclays analysts are talking about? Are you not seeing channel check weakness?
I mean, look, everyone has their opinion, but for the last year, people have talked about channel check weakness, and it's essentially been a fictional Netflix story, in terms of what's actually come through. I'm not saying it's roses and champagne, but when I look relative to street expectations and relative to the upgrades, I mean, Tim, we have not seen any cuts at this point in the cycle out of our Asia supply chain checks. And you would have already seen that now. And I think look, Apple's like Rocky Balboa. Every time they're like, it's over. It's done. The growth's done at $1 trillion, $1.5 trillion, $2 trillion, $3 trillion. And I think that cycle, it speaks to our view of we're in the beginning, in our opinion, of a new tech bull market. And to be bearish on Apple going into this, it's the exact opposite of what we would be doing.
Having said that, Dan, up almost 50% last year. Is there some expectation that some investors are going to be taking profits, that there could be a little bit of a pullback after such a run like that? I mean, do the fundamentals justify that almost 50% run up in 2023?
Yeah, and and we've talked about it. You're going to have pullbacks like we always do, and pullbacks are healthy. But from a valuation, I mean, our view, it's a sum of the parts. And that's really what started to happen with tech, with the godfather of AI, NVIDIA. We've seen it with Google. We've seen it with Microsoft. That's what's happened with Apple. I mean, when you look at the valuation today, this is Apple with zero valuation for AI, which is going to be the next phase of the story. So our view is we'll have some ebbs and flows here. But this is one where fundamentally we continue to think it's one where it goes higher on multiple, it goes higher in numbers.
Does Apple, I'm looking at revenues for 2023, Greater China was about almost $73 billion. Americas as a group, $162 billion. So certainly the biggest market. Will there always be a Chinese market for Apple products, in your view?
I mean, and look, and I think, and Carol, it's important because if you go back over the last 7-8 years, the bear story in Apple, if you go back $2 trillion ago, it's China, right? Eventually, that's the big bad one. Eventually, that market domestically, geopolitical. The reality right now, 20% iPhones coming out of China. And you have 100 million iPhones in China just in an upgrade opportunity alone. So that's something where the growth continues to actually expand in China for Apple. And I think you'll continue to have this as kind of a debatable point. But this is something that's just going to continue to expand, not contract, relative to what the average Chinese consumer wants.
Well, it's interesting because we just talked about ASML and the Biden administration putting pressure on it to not sell some of its really key China manufacturing equipment to that country. Do you think geopolitics between the U.S. and China ultimately find a way to get along? Or does that continue to, though, like, I just wonder, doesn't it eventually make it more complicated for a company like Apple? Although Apple very important to China in terms of the amount of workers it's got putting to work.
Yeah, I mean, at peak, it's second biggest employer in China, right? And I think even look at Tesla today. China numbers strong. So I think when you look at the political, sort of tightrope that's happened right now, because it's an AI arms race. So let's just call it between U.S. and China. And right now, because of NVIDIA, because of Microsoft, U.S. is actually ahead. It's going to be a balancing act, but our view is geopolitical is a background noise. I mean, this is the biggest tech transformation we've seen in 30 years. And it's one, you're always going to have these worries. The reality is it's a dysfunctional relationship that continues. They both need each other in terms of U.S. and China. And that will continue to go down this path. And actually, the tensions, I'd say, if anything, has maybe been toned down a bit relative to what we've seen over the last 3-4 months.
Hey, Dan Ives, want to get your take on another part of the Barclays downgrade, which has to do with the iPhone 16. It's a little early for us to be talking about the iPhone 16 after all these things are unveiled, usually in September. But analysts at Barclays argue that there are no features or upgrades that are likely to make the iPhone 16 more compelling. What do you make of that?
Look, they're probably the same ones that said you wouldn't have a Big Ten team in the national championship, and now you have two. So,
touché.
Look, it's always going to be, it's easy to take shots, right? But the reality, you're talking about 2 billion iOS devices, and you have 1.3 billion iPhones. That upgrade opportunity alone is going to be 240, 250 million units. And you look at iPhone 16, it goes back to Apple. They play chess, others play checkers. That's why most valuable company in the world. But you will look, the haters are going to hate. And you're going to come out, especially coming out of a new year, the fire in a crowd theater call. I get it. We've seen it many times in our almost 25 years covering tech. But we view it as a golden buying opportunity, not time to hit the elevator for the sell button.
So what brings Apple to $4 trillion? What is the next big thing from Apple? What's the one more thing, as Steve Jobs used to say?
It's good. And look, and obviously, one of the best thought leaders out there, Gurman, talks about it a bit, but it's AI. I mean, you have the biggest install base in the world. It's about monetize. We view it as going to be an AI app store. It's going to be ultimately something that gets rolled out over the next year, and this is going to be AI apps within the services flywheel.
But is that Vision Pro? Is that the conduit? Is that the device? Is that the platform?
Vision Pro, from a form factor, is the early stages of where this is all heading. The quick take would be like Vision Pro 3500. It's not going to change that's not really a focus Vision Pro, because 2 years from now, it's going to be a $1,200, basically look like sunglasses. It's all about developers now. Developers are going to build more and more apps. They're going to be AI generate, AR, VR. And that's going to further mine to the install base. But Tim, it just goes back to when they released AirPods, and everyone's like, if they sell more than 5 million a year, that would be the most unbelievable eighth wonder of the world.
I think I bought 5 million last year.
At peak, they sold 98 million in a year. So I'm just saying, Apple's one. It goes back to Rocky Balboa. Just continues to think it's over. Next thing you know, you're watching Rocky 8.
If, though, some of what Barclays comes true, and there are some issues, would you start to rethink a little bit differently, or would you just say maybe this is a little bit of a slower year than we thought?
I just view it as here and there, even some conservatism. I view it as overall slight turbulence chop that's ultimately going to 40,000 feet with smooth air in terms of where this is all heading. So that's sort of my view in terms of how this is going to go. I'm not saying it's not going to be, you're not going to hit some chop getting there, but that's the nature of Apple. That's how it always is. And that's why you're always going to have ones where the skeptics try to say this is the year it's over, innovation's done. And yet at the top of that mountain is Cook and Cupertino.
So what about Musk and Tesla? A little bit of a transition, not a good one, sorry.
Another,
but you've got an outperform. You've got a $350, I think, a share price target on this one. Some news about them falling behind BYD in quarterly EV sales growth slowing. What's your thoughts on Tesla here?
I mean, deliveries today was the flex the muscles. I mean, beat the street. China, a lot of the price cut, that price war has actually subsided. Strong China numbers. Cybertruck, we look demand to supply is 10-1, in terms of what we see out there. And I think this is actually the next phase of the Tesla growth story that's coming in the next 1, 2, 3 years in terms of full self-driving, supercharger, as well as they, ultimately they're diving into the deep end of the pool. Others are peeling back in Detroit. So for Tesla, it's another one where many continue to bet against Musk and Tesla. That's been the wrong bet.
How do you feel, Dan, about BYD? It's now ahead of Tesla when it comes to quarterly EV sales.
I mean, I'm a big fan of BYD. What they've done, I've seen it firsthand, is amazing. It's a 2-horse race in terms of essentially what's happening here. But this is not a zero-sum game. In other words, there's not just one play. We're talking about the biggest the biggest transformation to the auto industry since 1950s. The green tidal wave that's come. And others will say, okay, EV demand is
Yeah, that's what I was going to say. Is the demand there? I was having a conversation with my dad about this, who loves his EV, and, he has a Ford. And I've talked about this a lot, Carol, but, he took him so long to get it after he ordered it, Dan. And now they can't get these things off of lots because people aren't buying them. And he had a good point. He said, everyone who has an EV actually wants them, and you can get an internal combustion engine car for a lot less money. What about the demand question, Dan?
Just got about 30, 40 seconds.
I mean, for demand, I think it was maybe overestimated a bit, but we're still going at 25, 30% of automobiles are going to be EV from 3-4% today. And that's why eventually, likely, your dad might be driving an EV in the near future.
Oh, he's got the Mach-E. Loves it.
But he had to wait forever, right?
Yeah, he had to wait forever
to get it.
My mom loves it too. She drives it more than my dad does.
Dan, do you drive an EV? Just quickly.
Yeah, so and I'm also on the Cybertruck list. So when I'm in the Cybertruck, I'll pick you guys up on Lexington, and then we can drive it.
Deal.
Sounds
Dan
good.
Ives, such a treat. Great to have you here on this first trading day of 2024. Only thing is, I wish we could see you because you are a killer dresser. And it's always
next
fun.
time.
Yeah, next time. Get home safely. Dan Ives, Managing Director, Senior Equity Research Analyst at Wedbush Securities, talking to us about Apple and Tesla, two of some big outperformers last year.
He's bullish on 24.
He is indeed. All right, you're listening and watching Bloomberg Businessweek. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, just under 18 minutes to go in the first trading day of 2024 here in the United States. And we've got stocks down across the board, as you just heard from Charlie. Really, the underperformance today in the NASDAQ down about 2%.
I'm still writing 2023 on my checks.
I was just going to say, do you still?
No, the joke is that we don't write checks anymore. So.
I think I have one or two people that I sometimes write a check to, but yeah. Remember we used to run out like, I got to order new checks. No.
The checks that I have are like 3 addresses ago.
3 addresses.
Yeah.
What are you saying? What are you saying? I will tell you what our next guest is saying. He says, cash is still king. Let's get to the drive to the close. With us is Rich Weiss, Chief Investment Officer of Multi-Asset Strategist over at American Century Investments, $230 billion in assets under management. And Tim Ridge is joining us on Zoom from Los Angeles.
Hey, Rich, good to have you with us this afternoon from sunny LA. Why is cash still king?
Well, it's been king, I'd argue, for the last 2 years. If you look from the start of 2022 through the end of 2023, cash basically outperformed most equities, maybe not the Magnificent Seven, but most equity portfolios. So cash has been king, likely to be king, at least for the first half of this coming year, at least we believe. You can make the argument that stocks have gotten a little ahead of themselves. Whether or not we have a hard or soft landing, we don't believe there's going to be 6 Fed rate cuts this year. And right now, the U.S. has this, I guess you'd call it a dubious distinction of topping the charts in the developed economy world on 2 key financial ratios, debt to GDP and PE ratio. Which are hard to reconcile if you're betting on equities this first 6 months of this year.
But what if you had cash that you wanted to deploy over the last couple of years and you kept it on the sidelines because money market funds were paying you 5.25%, and you missed this run up at the end of 2023, and you're sitting there with this pile of cash and you're like, wait a second, now I'm back to where I started in early 2022.
Hey, money manager of mine.
Yeah.
We missed the rally.
Yeah, Listen, market timing in the short term, it's a tough thing. I'd rather call sunspot activity, quite frankly. But for the longer term, any reasonable investment horizon, again, I think that the downside potential of stocks, the disappointment potential here economically and in earnings outweighs, the potential upside. And cash is safe, high grade, fixed income. Just suggest you wait a little bit longer here. Just wait for some capitulation.
Well,
right?
I feel like people,
pullback.
I got to say, Rich, I feel like investors are getting the memo. U.S. money market fund assets rebounded after 2 weekly outflows. So assets rose to $5.89 trillion in the week to December 27th. This is coming from the Investment Company Institute. So we did see some back-to-back weekly declines, but we saw the money market assets come back, led higher by flows into government funds. We talked a lot last week on air about all of the money sitting in money market funds, and when it comes back, does it ultimately head into the equity market? Is that your best guess right now?
Yeah, I'd say that's a nice summary of it. Money building on the sidelines, but it's just hard to bet on equities right now, again, because it's hard to see where the fuel is for higher PE ratios. If you assume corporate earnings are going to grow by maybe 5% this year, maybe 5 to 10% at best, with interest rates where they are, where's the fuel? The manufacturing sector still in recession, housing sector still not doing well, arguably might be turning the corner, but yet to be seen. You have the lagged effects of monetary policy still wafting their way through the economy. Obviously, you have geopolitics out there as a cloud in the horizon, and an election year. It's just there's a lot of headwinds here for equities, a lot of potential downside. It's just the safe play, a bird in hand seems to be the more prudent path, at least for many of our portfolios at the margin. I'm not saying to get out of stocks altogether, but as you're seeing today, taking some profits from a very healthy last year, at least in the last quarter run up, and wait and see what happens here on the economic side, especially in the labor markets. And we're going to get a good look at that this week, right?
Yeah, we will. So my question for you is about capitulation and what capitulation actually looks like. When you say people should wait and see or wait for capitulation, what's a signal to you that they should be buying again?
Oh, it's going to mean a 10 or a 20% crack in the equity markets. Let's say 10% drawdown. You'll forgive the expression, they call it the market puke. Okay, but it's basically when the market gets it out of its system, it takes out some of this fluff in PE ratios right now. Where's the S&P sitting? I think it's somewhere around 20, 23 times earnings. Again, with rates where they are now, corporate earnings maybe in the single digits this year. That's a lot to ask from equities. And so we would expect a drawback in equities in this first quarter at some point.
A little perspective, though. I just want to jump in for a second because, listening in on some of the guests on earlier morning TV and radio, one of the guests pointing out that if you look at the market over the last 2 years, the S&P 500, it's really been a sideways move. We really haven't gone anywhere. We're up maybe 0.08%. So having said that, I don't know, what kind of insight does that tell you about kind of the levels we are today, and maybe there is some more room to the upside despite the dramatic rally we saw late last year? And how much of it is contingent on soft landing versus hard landing?
Right. I think, equity market arguably fairly priced, to your point, Carol, that it's basically gone sideways and it's a coin flip, depending on where we're going economically here. But our view, if you look, let's say at the last, I think it's 12, monetary policy hike sessions. I think that goes back to 1960 or so. 8 of those have led to recession. Only 4 were soft landings. And the 8 that did lead to a hard landing were very similar to the scenario we just saw, where rates rose precipitously. In a hurry, and the manufacturing and housing sectors got hit hard. So this scenario looks a lot more to us like those hard landing scenarios. But again, whether it's a hard or soft landing, I think that's an academic debate to some point, because I believe the equity markets already priced in at least a good portion of the soft landing, Goldilocks, immaculate disinflation, Santa Claus rally, all of which have one thing in common, which is that they're fairy tales.
All right. Well, we shall see. Of course, it's just the first trading day of 2024. Rich Weiss, Chief Investment Officer of Multi-Asset Strategies at American Century Investments, on Zoom from LA. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.